Welcome back, everyone, to the program. I'm your host, as always, LitecoinLeader. Today, I want to talk about the banking sector. There's a lot of news going out today with banking. There's even more things that are happening tomorrow. I'm going to get into all that, why the banks are going down, why the banks are having so much struggles. I'll dig into that. But before I do, please hit that little like button, that share, that subscribe, that thumbs up, that notification bell, and all that good stuff. And if you like this kind of content, please leave a comment down below. Please share videos, helps to grow the channel. Really appreciate it. Now, on to the core stuff. First off, a lot of banks are having problems, and I'm going to share an article here. I'm going to go over that real quick. The banks are having problems, okay? And it's going to get even worse on Wednesday, and I'll touch on that in a moment. But first, here's the article from MarketWatch. Regional banks are under renewed pressure. First off, on Tuesday, JP Morgan, day after JP Morgan Chase and Company bought First Republic Bank, which was intended to shore up confidence in the U.S. banking system, but it's not happening. PacWest Bancorp was down 29%. Western Alliance Bancorp fell almost 25%. Metro Bank Holding Corporations, Metropolitan Bank, dropped almost 24%. KBW Nasdaq Bank Index was off by 3%. Everything's down, okay? Everything's down. Meanwhile, among the Wall Street banks, Morgan Stanley is reportedly planning to lay off 3,000 workers. JP Morgan fell 1%, and Goldman Sachs Group dropped 2.6%. What is going on? Don't pay attention to those numbers down below, because as you can see here, even though they're saying that it's only down a little bit, but they're tracking after hours, because I'm recording this after hours. This morning, you could see that at the opening market, Pacific West was at almost $9, and now they're barely even two-thirds that. So they lost about 25% today, 25, 35%. So let me drop out of here and just talk to you guys and tell you what's going on. So here's my take on what's really going on, and that is the banks cannot create income. They can't make money. That's their job. They make money. And I'm using money and currency interchangeably. Yes, I realize that. They're not the same. I know. But banks' job is to increase their shareholders' wealth. That's the point of a bank. The way that they do that is they make money on by lending money out. The difference between the rates that they get for lending money out versus the interest that they pay people, which is virtually nothing. So they've been making money for the last 5, 6, 7 years by selling mortgages and loans to everyone, especially when the interest rates were 2, 3, 4%. You can go out and get a loan in your car, go refinance your house, buy a new house, all that stuff. And what they would do is the way it works is that they would write those mortgages or auto loans, but let's focus on mortgages because it's even more constrained there. The mortgages, almost no bank keeps them in-house anymore. They go into what they call mortgage-backed security, which is a pile. I've done a video on that. I'll put that link up here to explain mortgage-backed securities. It's kind of like, I think it's the one I did with the cards, where they take, originally, they take 4 really good mortgages and put them together, right? So now you have all A-rated and all rated stuff. But after a while, they were running out of A mortgages. They started putting anywhere from a king to a 2 in the mix, but calling it great. This is really the subject matter of The Big Short. If you haven't watched The Big Short, you certainly should, because it's happening again 15 years later. Back to what the banks do for a living. What they do to make income is they sell loans. That's how they open up accounts, sure, but their main way that they do make money, and again, fractional reserve lending, right? For every $100 you give them, they loan out $90. Then someone comes and deposits $90, and then loan out 81. And that's assuming they have to keep 10%. They just keep doing this. They make money by making loans. Well, look at the loan environment today. Mortgage rates are 6, 7%. It's not pretty. And to buy all these inflated houses that have much higher values, as if the interest rates were 2 or 3%, because your payments would be much lower at that rate, like 60, 70% lower than an interest rate of 6 or 7%. So now you have a house that's like maybe somebody's asking $700,000 for it. But given the mortgage payments now, someone can only afford like $400,000 to be able, like that house would have to be $400,000 for them to afford it versus the $700,000 asking price. So what happens? Buyers get frustrated because they can't get a loan for what they want to buy, or they can't afford the payments of what they want to buy. Whereas sellers are frustrated because the market has fallen apart and they can't get their $700,000 home, or what they told was their house was worth $700,000. That's not realistic anymore. So banks not to make them, not to make them a hero in this story, but they're stuck in the middle, right? They can't make mortgages to buyers because buyers can't afford those payments. They can't make new loans because, like, as much as they want to sell a loan product. But in order for them to sell a loan product, they have to have a buyer for that loan product as well. That's because no one keeps the loan inside the bank's walls. Or inside, even within the company. They sell it into these mortgage-backed securities. They sell. So let's just take 50 mortgages that they write. They bundle them all together, hopefully with the right levels of risk or balance it out to be accurate, so you don't wind up with all these in there, and then they sell them onto Wall Street as mortgage-backed securities. They sell them to pension funds. They sell them to insurance companies. They sell them to governments. They sell them to like anybody that's got a bond or wants to buy something with a yield and has liquidity. They sell it to them, and like, here's a mortgage. Like mortgage real estate never goes down. Mortgages never go belly up, and they buy these products knowing that they're going to get this return because people pay their mortgages. Well, the mortgage market is completely dried up now. Who's buying houses with the interest rates triple, 2 to 3 times what they were a year or two ago? So now banks can't make those kinds of loans. Now people are struggling all over with inflation and making ends meet. They're not getting new cars. They're not buying things, or they're not getting vacations. They can't even tap into their home equity line of credit because banks can't sell those loans either. So even if you say that your house is worth $700,000, you may only owe $300,000 on it. So on paper, you have $400,000 of equity, 700, 300, 400 in between. So normally in a normal environment, you can go to the bank and say, you know what, I would love to have an home equity line of credit that I could tap if I want to add a deck, go on vacation, whatever. Let my house pay for that. And I understand there's finances to pay it off. And sure, people make those decisions. But right now, they're cutting off HELOCs, the home equity line of credit. They're cut off. Banks aren't allowing them anymore because they can't sell them to someone else. If you go and set up a home equity line of credit for a couple $100,000, first off, they question the value of the home now, even more. And secondly, what are you using the money for? And third, if you're borrowing the money and they package that into a secured loan product, who are they selling it to? The same thing is happening in the auto industry. The interest rates on autos are like 15, 20%, if you can even get a loan right now. And people are they can't qualify for these loans. They can't buy things on credit. Credit is drying up and people aren't just getting loans. So the banks are, again, stuck in the middle. So the banks have worse earnings because they can't sell loan products. So now the banks struggling and they're going to have layoffs of people. It's going to be a vicious cycle for the next 6-12 months as this all plays out and the system just kind of devolves and it crumbles before our eyes. But in order to build something new and something better, you must tear down the previous version. Just think of any high rise in a major city. To build in that lot again, you got to remove what was there in the first place. So could this be what was happening right now with the banking system? We'll see. Some of us are more hopeful than others, but it's going to be messy no matter what. People are going to lose jobs. People are going to lose incomes. People are going to lose retirements. It's unfortunate. And hopefully they can figure out a solution, but there's no soft landing here, right? The banks are just one sign, and it's just another canary in the coal mine that we're seeing that the system is finally starting to crumble because they just over leveraged it and just lived on credit. So a lot said today. I know it's a little bit of a downer, but you need to know what's going on in the market. So what are your thoughts? Please leave them down below in the comments. I read them all. I respond to them as well. I love interacting with you guys, and I love you. Thank you so much for watching these videos. I really appreciate it. Again, like, share, subscribe, share these videos, help people to understand what's going on. And with all that said, I'm going to close the door in the bureau, say follow the leader, and I will talk to you soon. Take care.